Hello, this is Jose Cobo, and I will be covering highlights of economic indicators as of Q1 2023. This slide shows real gross domestic product, or real GDP, and it is a measure of U.S. economic activity adjusted for inflation. Early estimates show the economy grew at an annual rate of 1.1% from the prior quarter. The third reading for the fourth quarter, based on more complete data, was released on March 30th with a rate of 2.6%. The Bureau of Economic Analysis releases three estimates per quarter of GDP, and it is not uncommon for results to be updated from the first or advanced estimate and the third. In this case, there was a 1 basis point decline from the second reading of 2.7%. The Atlanta Fed's GDP Now is a running estimate of real GDP growth based on available economic data for the current measured quarter. As of May 24th, the Q2 real GDP estimate was 2.9%. After the housing starts report from the U.S. Census Bureau, the nowcast of second quarter real residential investment growth increased from minus 6.3% to a positive 0.6%. After hitting a high of 14.7% in April 2020, the unemployment rate breached the pre-pandemic low of 3.5% in January this year, when it briefly hit 3.4%. The unemployment rate is currently 3.5% and relatively unchanged since July of 22, when the prior record low of the same rate was reached. The number of people in the labor force as a percentage of the civilian non-institutional population or non-governmental population, the participation rate is the percent of the population that is either working or actively looking for work. This graph illustrates the period of decline in the labor force participation rate. After peaking at 67.3% in March of 2000, the labor force participation rate declined consistently to 62.4% in September of 2015 and had since flattened out. The pace of growth in the labor force picked up slightly to 63.3% pre-pandemic. The participation rate has steadily increased after reaching a low of 60.1% in 2020 and is now above pre-cycle lows with a rate of 62.6%. The following graph shows the number of employed women aged 25 to 54 years old and the number of childcare workers indexed to 100 from February 2020. Because women are more likely to be responsible for childcare in the household, the comparison between female employment and childcare employment proves interesting. The level of employment in childcare declined much more than the level of employment for women in March and April 2020 due to the closure of childcare centers. While employment in childcare still has not recovered from its decline, it is important to note that women's employment has surpassed its February 2020 level. Many households were financially distressed during the COVID-19 pandemic, struggling to pay for necessities such as rent and groceries. It may seem surprising then that the aggregate personal savings rate has actually increased since the start of the pandemic. In 2019, the personal savings rate in the U.S. averaged 8.8%. By 2020, it had almost doubled to 16.8%. After reaching a low of 2.7% in June of 2022, it has ticked up now to 5.1%. The dotted red line is the pre-COVID savings trend line per Federal Reserve economist. Since the fourth quarter of 2021, the blue line has been below the red dotted line, which signifies a rundown in excess savings of around $1.3 trillion. It also suggests that, as of the first quarter of 2023, households still had aggregate excess savings of about $1.1 trillion. Finally, this slide provides the three main measurements of inflation: Consumer Price Index, or CPI, Personal Consumption Expenditures, or PCE, and Producer Price Index, or PPI. The CPI rate of 5% measures the evolution of prices for a basket of goods a typical urban household would consume, including goods and services. In this measurement, all imports would be included, but not exports. The PCE rate of 4.2% is a measure of the prices that people living in the United States pay for goods and services. Now, this is the Fed's favorite inflation measure because it is derived from GDP data rather than from survey data like the CPI is. This is also not restricted to urban households, but includes more remote, rural family expenditures. The PPI rate of 2.8% measures the prices paid by companies for the goods and services they need to provide their products to consumers. It is sometimes referred to as input prices, and is really a measure of underlying inflation. The PPI covers goods, but not services. Overall, the downward trend of all three measurements of inflation is a welcome sight for those seeking a pause in Fed rate hikes.
Hi, I'm Carmen Mull, the Senior Finance and Liquidity Officer here at Stearns Bank. I'm going to talk to you about some of our rate indicators and liquidity in the banking sector. The Federal Open Market Committee, or FOMC, have increased rates by 500 basis points. The big question is, will they continue to increase or take a pause? Their next meeting is on June 13th through the 14th, with Chairman Powell releasing their statement on the 14th. A couple of the main indicators that they are watching involve the unemployment rate, which, as Jose mentioned, is currently at 3.5%. This is lower than they would like to see it, as well as job vacancies remain high. They are not seeing a big decrease in inflation, which they target to be 2% over the long run. That doesn't mean that they will wait for it to hit that before they pause or start to cut rates, but that is where they strive for it to be. They are also looking to see how the banking sector's tightening of lending will affect the economy. If it is harder for people and businesses to get loans, then their spending should decrease, which will ultimately affect inflation. As you can see, this round of rate hikes has been the steepest and largest, taking just 14 months to go up 500 basis points. This is very different than the last cycle starting in 2015, where they took 36 months to go up just 200 basis points. You may have heard of the FOMC's dot plot. The biggest thing to remember in reviewing this is that it is a prediction at a point in time. I have the year end for 2023 from their December meeting next to the one from their March meeting. As you can see, there isn't a lot of change in these 3 months, but the majority still feel that the range will be 5 to 5.25 at the end of this year, with us not getting back to the 2.5% range until after 2025. There has been a lot of talk lately about the unrealized losses in the security portfolio of banks. As you can see from this graph, it was the largest during Q3 of 2022. We have seen the mark-to-market valuations come up slightly in 2023. While this may seem like a small item that most people do not follow, it affects the bank's capital. This can also affect how the bank can get funding for liquidity. If the bank's capital ratios fall too far and they are not considered well capitalized anymore, they cannot access wholesale funding like brokered funds and Federal Home Loan Bank advances that many banks rely on. This also can affect their ability to participate in networks like IntraFi. IntraFi gives their customers FDIC insurance greater than $250,000. Capital ratios are very important to review when you're looking at the health of your current bank or any bank that you're looking to do business with. Stearns Bank maintains capital levels far above our requirements to ensure that we are here to support you, our customers. With the collapse of Silicon Valley Bank in March, some banks have seen an outflow of deposits. The majority of these funds have gone to money market funds. There are pros and cons to these types of funds, Know that what you are getting into prior to moving your money. If you're moving it because you are afraid your bank will fail, see if they have products like IntraFi that give you extended FDIC insurance. There are ways to insure your funds. Reach out to your personal banker to find out more. Banks that are seeing an outflow of deposit are going to the wholesale market and advances like the Federal Home Loan Bank or the Federal Reserve if they are well capitalized. We prefer to fund with deposits from our customers, but there are ways for us to ensure that we can still lend to our customers through times where our deposits may be leaving. Again, if you have any questions, reach out to your personal banker and they can assist you.
I'm Jill Molitor, the Chief Credit Officer at Stearns Bank, and I'll talk through some consumer and business highlights. The Federal Reserve released their Economic Well-Being of Households in 2022 report, and they're reporting that 94% of U.S. adults had a bank account in the last year, and use of relatively new financial services remains low, with 3% of adults reporting they use crypto for financial transactions and 12% reporting that they use buy now, pay later services. 73% of adults said they're doing okay financially in 2022, but that declined by 5% since 2021 and is amongst the lowest reported since 2016. Non-retirees reporting their retirement savings is on track declined from 40% in 2021 to 31% in 2022. Equifax reports that consumer financial stress is rising, with consumers placing more dependence on credit cards and revolving credit as consumer spending is currently running higher than disposable income. Now, there's record trends reporting for revolving limit and unit originations already in 2022, and that trend is continuing to increase in 2023. However, private label cards are on the decline due to changes in buy now, pay later, and changes in retail specific cards. Additionally, delinquency rates are rising for all loan types, however, remain relatively low compared to historical levels. Delinquency demographics indicate that 18 to 21-year-olds are driving this delinquency, and the pending end of student loan relief could add an additional stress point. Delinquency by geographic area shows an increase in delinquency year over year, however, not showing as much of an increase in delinquency when compared to bank card and personal loan delinquency. Equifax reports a decline in new unsecured personal loans by limits and units, and that's attributed to tightening of credit standards. I would mention, however, that home equity lines of credit are showing a decline in new limits and units thus far in 2023 after seeing an increase in 2022. And that's because many aren't willing to walk away from their home, so they'll turn to other means to supplement cash if needed. Delinquencies for bank, card, and personal loans are increasing year over year, with geographical pockets showing an increase more in some areas than others. Business Experian reports statistics taken from Freddie Mac, noting existing home sales increased slightly in February and March after declining from October to January. However, existing home sales are down significantly when compared to January 2021 through June of 2022. And this is largely attributed to the rising interest rate environment, which includes mortgage rates, along with supply constraints and increased construction costs that we'll discuss more in the next slides. Many aren't selling their homes if they don't need to, if they're locked into lower rates, and if they don't have to move. However, some inventory challenges are easing. Mortgage originations are projected to be down through 2023 for originations, though may be increasing in 2024. And starter homes might pose an opportunity to increase new construction, as potential first-time home buyers are usually heavy users of FHA and low down payment programs, and so they need starter homes available to them, which are currently in low supply. Equifax reports a decline in mortgage applications with levels similar to the Great Recession, and this is due to higher prices. However, some sellers are starting to reduce the price of their homes. Business Experian reports statistics taken from the St. Louis Fed, and they're noting that total construction spend continues to trend upwards. And this is driven by a combination of higher material costs, increased interest rates, the cost of capital, and high construction demand. Prices of some materials, such as the cost of lumber and plywood, have started to decline to more normal levels. However, iron, steel, and asphalt prices remain inflated when compared to historic levels. The result is less affordable homes due to rising prices and rising interest rates, and less are willing to sell if they don't need to, especially if they're locked into lower rates, resulting in a reduced volume of homes on the marketplace, even though sellers are starting to reduce the price of their homes in some cases. According to the Coleman report, 31% of small businesses borrow once every 3 months, and that's a higher reading than the prior 3 years. However, 6% of borrowers reported some level of difficulty securing financing, and 8% expect credit conditions will worsen in the next 3 months. Additionally, average interest rates on short-term loans have increased by 0.7%, and that results in a 4% of small businesses claiming that financing and interest rates pose problems. Now, this bodes well for Stearns as lenders tighten their underwriting standards, but we continue to research and pursue the right industries that align with our risk appetite and our desired portfolio concentration. Business Experian reports a statistic taken from the U.S. Census Bureau that new businesses continue to open at a high pace, with March of 2023 showing the highest seasonally adjusted monthly volume since June of 2021 for new business formations. Business Experian reports statistics taken from the U.S. Census Bureau, and they note that commercial construction and manufacturing construction experienced the largest growth in non-residential construction spend. Now, note that commercial includes buildings and structures used by retail, wholesale, and selected service industries, while manufacturing includes buildings and structures at manufacturing sites. The construction industry is driving new construction businesses to open, resulting in their demand for new credit and a 28% increase in new business applications when compared to 2019. Business Experian, however, reports increased delinquencies in the construction area, which recently exceeded pre-pandemic levels. And these increased delinquencies have resulted in some lenders tightening their underwriting standards. Ultimately, the increased rates and tightened underwriting is resulting in a decrease in the amount of commercial credit, a trend that started in mid-2022.